Greetings, everyone. This is Kathy Wood from ARK Invest, and this is Employment Friday. So in the summer, August this year. Let's see, fiscal policy, monetary policy, economic indicators, market indicators, and then a little about innovation. Fiscal policy. Well, we got a downgrade. Fitch downgraded government debt this week. And some economists are treating that with alarm, and others, including strategists, are treating it with a yawn. And the truth is probably somewhere in between, as is usually the case. It really is a sign that our spending, the government spending, in the last 5-6 years has just been out of control. And my reaction to it is, hopefully this is a warning to the legislature and politicians generally that, the spigot is going to have to stop. And it's interesting, as I look in the GDP accounts at the government line, it's actually shrunk as a share of GDP, and most of the spending is not in the GDP report. GDP is production of goods and services in the U.S. economy. And a lot of the spending has moved off into social programs, which are not part of GDP, like, say, defense would be. So I think that topic is going to gain a lot of currency. Maybe they'll skip through it over the election year and campaign season, as they usually do. But I do think Fitch is warning us that we're going to have to deal with this issue in one way or another. Our point of view would be enact policies that encourage very rapid growth, because we're on the threshold of some technologies, as you know, we talk about them all the time, really turbocharging growth. And the best way to get out of a debt problem is to grow out of it. So that's one thing. The other thing that happened that was kind of interesting from a fiscal policy point of view, especially now that we've entered the election campaign season, was movement on crypto legislation in the House. Now, we don't think it will get out of the House because Maxine Waters is head of the Financial Services Committee and is not pro-crypto. But crypto, or as Art Laffer would say, could you please use a different word, like digital assets legislation? We do think that it will become an election year issue. And the fact that it's even stirring in the House at this point in time and becoming a conversation, we think is going to work to the benefit of crypto. And what's very interesting is, whereas we thought we had a bipartisan issue in crypto, the side seemed to part, especially with Elizabeth Warren siding with the banks, interestingly and unbelievably, that we need to be very careful in this realm. We should not trust it. So we thought there was a partisan divide evolving, but we are seeing some Democrats coming back to these bills. There were two that were voted. Well, one has been voted on already, and it got 6 votes from the Democrats. And the next one, that one was on market structure. The next one is on stablecoins, and apparently that will have many more than just 6 votes from the Democrats. So this could become, yet again, a bipartisan issue, which we think it should be. Innovation solves problems, and this crypto legislation would really put in place the layer of the internet that no one contemplated in the early days of the internet, because it simply was a place to exchange information. Nobody thought about commerce or financial services. And so we think it's important, and it will take a lot of the cost of financial services out of the system. Then on monetary policy, which is somewhat related, we think, for example, Bitcoin is the first global, private, meaning no government oversight, digital, rules-based monetary system in history. It's a very big idea. And Art Laffer is becoming very excited about this notion that we could be going back to a world of private money. So before 1913, when the Fed came into existence, money was private. And we've done a podcast, you can look for it on our FYI podcast, about this period of time. And while I have always thought it was characterized by booms and busts, and it was, what Art says is those booms and busts happened very quickly, six week periods of time before they'd clear up. The booms and busts that have evolved since the Fed took control have been many years in the making, and then when they happen, they are extremely destructive. So just putting in a plug for that. Anyway, on monetary policy this time around, Chairman Powell, in his testimony to Congress, basically used the word restrictive to describe monetary policy, which is a big step, I thought at least. And he wasn't thinking about it in terms of the money supply. And as you know, we've been talking about the money supply falling on a year-over-year basis. And in fact, if you go back into 2021, you'll see that the money supply really hasn't gone anywhere in 2 years. This is extremely unusual and negative year over year, as I've said on all of these calls, since M2 growth turned negative early this year, that we have not seen since the 1930s. And we've also seen a collapse in banks' willingness to lend. They're very worried about the health of the economy, and they're facing even more capital restraints, we've learned in recent days. So monetary policy is restrictive, but Chairman Powell was referring to real rates when he said that. So the Fed funds rate is at roughly 5.5% now. And CPI inflation, that's headline inflation, is 3%. That's 2.5% real rates. And if you look back, you'll see that rate, real rate, 2.5%, was the peak right before 08-09. So that's somewhat concerning. But more concerning to me is that the inflation rate is coming down so rapidly now that what if we're at 5.5% on the Fed funds rate and 0 on inflation by the end of this year, which we believe is a real possibility? That would be a 5.5% real rate. And we haven't seen those since the 80s, when the Fed was all about fighting the return of double-digit inflation. That's not where we are right now. So I think that what's going to happen in the next few months, as inflation continues to come down, is that more and more people will be talking about this real rate, which is really starting to mount. And I think it was healthy to hear Chairman Powell refer to monetary policy as restrictive. So half of the solution is understanding the problem. If he thought monetary policy was still too easy, that would be a big problem. So if you look at M2, you can go back to August of 21 and see the same level. And the other thing that I think more and more people are discussing is what Milton Friedman taught everyone, and that is that monetary policy impacts the economy over and these are variable time periods. I think at times he used 6 months to 18 months. Well, right now we're at about that 18-month period, and we haven't hit a clear-cut recession. We've had rolling recessions, certainly housing and autos, manufacturing, and so forth, but we haven't hit the big one, the recession. And in fact, what's happening, to many people's surprise, is inflation is coming down faster than they have expected. A lot of people were of the view, like Larry Summers, and I think he's still there, that we are closer to a 70s style inflation than most people think. We disagree entirely. And I think many people who follow Larry and others are surprised to see inflation coming down so quickly. And so we're hearing talks of the Goldilocks economy. Goldilocks economy meaning soft landing in response to monetary policy, and inflation coming down to that 2% area. And then we're on our merry way. But if money and monetary policy, money, interest rates do impact the economy over an 18-month period, well, here we are. If this is the start, what could that mean? Well, it could mean a couple of things. How would we get our soft landing? Well, if prices went down and companies were willing to accept lower margins without firing people. Right now, they're hoarding people, and we can see that from the latest employment report. But if they were willing to accept much lower margins as prices come down, then I think we'd have a soft landing because the unemployment rate would not go up. Now, I don't think that's going to happen. I'm very pleased to see inflation doing what we thought it was going to do, but it only means that monetary policy is that much tighter. And I do think that companies now grappling with margin pressure are going to start making tough decisions about employment, especially if the grips of monetary policy get stronger as real interest rates go up. One of the things that I mentioned in our last call and that we're still noodling over is this divergence between GDP, gross domestic product here in the United States, and GDI, gross domestic income. Now, they should equal each other over time. They're an identity. But they're measured very differently. And in fact, the income measure is much easier to get at because tax documents are the source of a lot of the data. And so in the first quarter, last time I mentioned to you that on a year-over-year basis, GDP was up, this is nominal GDP, was up 7.2% in the first quarter. And GDI was up only 4.5%. I think I should have also read out the numbers at a seasonally adjusted annual rate, so quarter to quarter annualized. And on that basis, GDP is up, was up 6.1% in the first quarter, but GDI was up only 2.2%. So this is a huge discrepancy. I don't think we've ever seen this big a discrepancy. And it is going to sort itself out. And if we're right, what that means is that the resolution will be revisions in lots of economic data down during the next 6 to 9 months. Now, in terms of the economy, so economic indicators, the reason I'm focused once again on this discrepancy between GDI and GDP is because what we're hearing from companies is very different from what the GDP statistics are telling us in many cases. But before I get into that, I'll just go through today's employment report. It fell below expectations, so non-farm payroll increased 187,000. The expectation was 200,000, so not too far off the mark. But when you adjust for the downward revisions to previous months, the net was 137,000 jobs. Now, as has been the case for the last, year and a half almost, other measures of employment are contradicting the non-farm payroll. This time it's household employment. Household employment was negative, I think, in May to the tune of 300,000, but it's coming back, and it was up 268,000. So lots of cross currents. But one thing we are seeing, and I think is really important, is the average work week is going down. So it went down 0.3% in July. And what that tells us is that companies are still hoarding labor. They're afraid to let employees go because they had so much trouble attracting them in the last couple of years, especially in and around COVID. So I do believe that they're going to face severe margin pressures as they hoard labor, and their pricing power diminishes even more. So I believe that the average work week has not been this low since at one point in 2020 during COVID. So that gives you a sense of the labor hoarding. The employers don't want to lay people off. They'll just give them fewer hours to work. Average hourly earnings were up 0.4%. That was a little higher. Again, the Fed's watching that. Others who are very focused and remember the 70s style inflation are focused on wages, because wages went up and pushed through into inflation because monetary policy accommodated. Money supply growth certainly wasn't negative at any point during the 70s. So 0.4%, and we're hearing about these settlements either before or after strikes. Very big numbers, 10% for some of the airlines, and perhaps other manufacturing industries. I've heard 8 to 10% a number of times. Well, the difference between here and the 70s is, yes, monetary policy accommodated those wage increases, and we ended up with double-digit inflation. Monetary policy is not accommodating these wage increases, and so what that tells me is there are severe margin pressures awaiting the companies that are agreeing to these kinds of settlements. As far as other indicators in the labor market, we do have some leading indicators. Temporary employment is falling, and we had Robert Half, which is temporary help for CFOs, so temporary CFOs, temporary controllers, higher level positions. Their revenue dropped 12% in the second quarter. Manpower, which is much broader based, light industry, administrative, and so forth, its revenue dropped 4%. So that gives you a sense at the margin that labor is softening. The job openings came out lower than expected and continued to fall. In the technology space, it's very interesting. We're continuing to hear and read about job losses there. And in listening to the earnings reports of this season, I think the technology companies, especially those in Silicon Valley, seem to have all gotten the same message, which is, you know what? AI is so powerful and is going to introduce so much efficiency and productivity that we should lay people off, because we will keep our competitive edge that way. Sure, the advertising market was a reason, a soft online marketing and advertising was a reason last year, but they're continuing to shed jobs as some of those indicators come back in terms of online advertising picking up a bit. And I do think this sentiment is going to cascade through many industries. We think artificial intelligence is applicable to all industries. And bringing in efficiencies and productivity gains. So we think that's also going to become a major source of loosening in the labor market. We will know when that's happening from initial unemployment insurance claims. They have started up and they had gone up to 250 to 260,000 from roughly 180,000, and now they've backtracked to 225,000. So we don't see this full-blown, hey, we better keep our efficiencies up, especially if we can't rely on pricing anymore, and lay some people off. The GDP report was a nice eye-opener. This is where I think a lot of economists had an aha moment. Real GDP was higher than expected, but it wasn't because of consumption. Consumption was up only 1.6%. Real GDP was up 2.4% because investment was up 5.7%. And government spending was up 2.6%. So there was that stimulus in there, stimulus programs still getting into the GDP, especially through infrastructure. And the investment is being helped by onshoring here in the United States. And that will be a buffer. That will be a buffer against a severe recession. But we do see the consumer slowing down, and inflation was 2.2% at an annual rate. That's the GDP deflator, the broadest base measure in the US, 2.2%. So we're just about where the Fed wants to be on its metrics, but they are lagging indicators. And, you know, we have some real life earnings reports to inform us here as well. I'll mention Costco. Costco, if we listen to John Lilly, who is one of the contributors at our brainstorm every Friday, and he's the former CEO of Pillsbury, very sensitized to inflation, deflation in the food space, takes lots of trips to Costco to check out the scene, and he believes there's outright deflation taking place. And that you may not see it in terms of the listed price, but in terms of all the discounts and deals that you can get, he says that's quite telltale. Conagra came out, and just looking through its report, its revenue was up 2.2%, disappointing. The refrigerated and frozen food section was down 1.1% in terms of revenue. And the CEO said, you know, we've watched the consumer grapple with budgets and inflation really hitting budgets. And up until now, they were trading down to store brands or generic brands. But now they're just foregoing and maybe just pulling out of their freezer and waiting for prices to come down. So pulling out of their own inventory that they probably built up during COVID at home. And then we have CSX, or rail. And I look at transportation companies, both trucking and rail, negative revenue growth. So CSX minus 3%. And, you know, it's been very interesting to go through this earnings season and to hear the media say, oh, better than expected, better than expected. What happens during a quarter is companies throw out hints and analysts take down their numbers, and companies lower expectations to such a level that they beat them. And you'll see, oh, 70, 80% of all companies are beating their revenues and earnings. Yes, that's because they've come in so much based on various kinds of guidance. And then there's this true inflation gauge that I mentioned. It too is down to 2.8, 2.9%. This is a daily metric you can pull up just to see what the real inflation measure is based on, I think it's 10 million measurements over the course of a month. So I think the real world is informing economists more than economic statistics are. They are quite confusing. So let's go on to markets now. What are they saying? Well, the equity market is buying into this soft landing, inflation coming down, interest rates coming down. It's looking over whatever the Fed is doing or saying now and is basically saying, hey, these inflation rates are coming down so rapidly that the Fed will have to follow them, especially now that that Chairman Powell has used the word restrictive in terms of monetary policy. That is a setup. And as I mentioned before, I doubt it's going to be soft because I think the margin landing is going to be hard. And if companies are willing to accept it, then and not lay off people, then the economy will not go into a recession. But I don't think that's going to be the case. I do think they're going to cut labor because the full impact of monetary policy has yet to be felt. If it's an 18-month lag, up to an 18-month lag, we could be, given that the last rate increase was in the last 10 days, we could be experiencing the impact of tight monetary policy for the next 18 months. The fixed income markets are basically moving up and the yields are moving up in response to a stronger than expected economy. So that real GDP growth number and they're responding less to the lower than expected inflation. And we know there are a lot of traders positioned on both sides. Some believe that the interest rate, the long-term treasury yield, is going to break out from the base that we've been in since October. Well, the base is longer than that, for about a year and a half. Last October, we peaked at 4.34%. Yesterday, we got into, I think it was 413, 414. And today, Friday, employment report, weaker than expected. The yields have come back in. We see the yield curve also narrowing in terms of its inversion. We were at more than 100 basis points, and that was trouble here in March, and we had just gotten there again, and now we're at 75 basis points, more because long yields have gone up than short yields coming down. And the spreads, if you look at the corporate spreads, corporate yields relative to treasury yields, they're well behaved as well. They are not saying yet that margin pressures are going to be a problem, but we think they will. So we think those spreads, depending on the industry, will start moving up as the economy weakens. Commodity prices, if you look at the Bloomberg Commodity Price Index, it has gone from 140, that would have been in March of 22 when Russia declared war against Ukraine and oil prices and food prices shot up. So we got up to 140 and are now down to 105. The downturn actually started in 2008 when oil prices peaked. We're down to 2005. But if you look at the base of the last, I'm going to say 40 years, we're still in a range. It's a wide range. But very recently, the trend has been down. And we don't think that trend will be broken. And then finally, Bitcoin, new asset class. After the excitement about BlackRock's ETF filing for Bitcoin in June, which rocketed Bitcoin beyond 30,000, it has come down a bit. It's around 29,000 now. And even more notable is the volatility has come down dramatically. In fact, we haven't seen this low of volatility since 2020, right before it embarked upon a major move. Now, sometimes volatility means that it's going to break down. So when there's very low volatility, you look for signs of, is this going to break out or is it going to break down? Given our on-chain analytics, we're on the bullish side, and we just put out the Bitcoin monthly this week, and you'll see those signals. On balance, they're very positive. So the internals of the market, the on-chain analytics, are telling us that we're probably, if there's going to be a break either way, it will be a breakout to the upside. And as you'll remember, the last highs were 70,000. And this has been a market that has been moving. It's been moving such that we have higher highs and higher lows with each cycle. It's very volatile, of course, as we all know, but higher highs and higher lows means we're in a secular bull market. And if you'd like to understand more of the reasons why, you should tune into the crypto brainstorm that we published with Bitcoin Park in Nashville, Tennessee. We have partnered with them, and we are holding a brainstorm every month, and it will have a different cast of characters in the crypto ecosystem. This past one was fascinating for me to be speaking with Yassine, with individuals who are dedicating their lives to Bitcoin and taking us into that world in a way that I didn't appreciate. So I highly recommend it. And as far as anything else in the world of innovation, very exciting week, actually 10 days. About 10 days ago, there seemed to be a superconductor breakthrough, room temperature superconductor. And our chief futurist, Brett Winton, along with many others, said, this is probably fake. And he gave it a 10% chance about a week ago of being the real deal, a real breakthrough. Today, he and others, I think the betting markets are up to 40%. He and our team are in the 60 to 70% range. And we may not see commercialization of very much for quite a while. So if you're looking for a breakthrough in earnings based on this in the next year or so, no to that. But it might be bringing us much closer than even we thought to quantum computing, which would change everything. And we're doing a lot of research. Actually, our crypto team started doing the research on quantum computing because it's quite relevant to cryptography. And so stay tuned. We'll be talking a lot about that. I love it when we get excited about new ideas. AI has taken so much oxygen out of the room in the last 6 to 9 months that it's refreshing to be talking about yet another major breakthrough being possible here. So with that, happy summer. Have a wonderful August, and we'll see you after Labor Day.